Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 274th VideoCast podcast for the week ending January 16th, 2025. As always, we'll do family first and then get down to business. A huge amount of data to cover this week. But first and foremost, there's Mimi and Annabelle at the dog beach with Lucky and Pepper having a good time this week. And then there's me in Los Angeles last Friday with Charles Payne was in town. Got to do in studio and meet all the crew at the LA Bureau of Fox, which was a lot of fun. And then that's the entryway, which was pretty cool. Another photo there. So first thing, let's get to media. Want to thank Nick Palazzo and Allie Thompson for having me on Making Money with Charles Payne, Fox Business with Charles. This was an amazing segment. As a matter of fact, it kind of took me by surprise because, you send in some show notes and then they changed the whole thing up. And he's like, we're going to cover every pick you gave us last year. And I was like, okay, here we go. There'll be a lot of good ones, but there are a couple ones that haven't worked yet. But it was fair. So here we go.
Hey, joining me now, I want to bring in Great Capital Chairman Tom Hayes. Now, you guys know Tom Hayes from the show, and the reason I don't have Tom on more frequently is he's long-term, so he's going to tell you the same thing over and over again. But here's the thing. You want to listen to what Tom Hayes has to say because this guy has an amazing track record, and he's with us now. Tom, welcome to the show, man.
Thanks for having me, Charles.
I just want to go, so you're a long-term investor.
That's right.
So it's only fair to judge your ideas, I think, at least on a year-to-year basis.
Correct.
So let's look at what you gave us a year ago.
Let's do it.
January 2024. Citi up 33%. Bank of America up 33%. Google up 39%. Amazon up 46%. Is that Crown Cork right there? CCI. Yep. Crown Castle. That's the only one that's down. These are amazing numbers, my man. I mean, even with the 25% decline in there, you've got four names up 30%, one up almost 50%. The key here was to really, to know, the fundamentals, right? Yeah. And to have patience.
Yeah, we like to buy things when they're out of favor. Crown Castle, that's gotten hit by rates. It actually had a rally, and it's come back in. We like Crown Castle here. I think, it's very interesting when we see rates. I heard your A-Block, Jeff, talking about rates. I've heard Tom Lee out there. The 10-year yield did the exact same thing in Trump 1.0. Right after he got elected, it blew out. Yields blew out. The dollar rallied like crazy. Right after the inauguration, you know what happened? Bonds got bid. International stocks took off. All the things that people thought weren't going to do well under Trump did extremely well. Right. And what actually did poorly that first year? Energy did poorly that first year. Yeah. And ironically, in this last year, solar stuff has been a disaster, right? Under the solar stock of Biden. Solar did great the first year of Trump.
Yeah. So it's amazing when they zig, when they zag, and the markets start to price this thing, or they start to be in there. So what are you saying? Because the average holding period, like let's say 1960, people used to hold stocks 6-7 years. Yep. It's down to 5 months. Yeah. So is it tough just getting folks to hold, particularly when they don't move in your direction initially?
Well, it's interesting. This has been an aberration, and we're all blinded by recency bias. Since 1927, value has outperformed growth by 4.4% per year. So what changed? Since 2010, growth has absolutely smoked value. And part of that has to
But is that a paradigm shift?
It could be. People say capital light models, et cetera. But what actually happened was zero interest rate policy. So unless you believe that we're going back to zero interest rate policy, which, today tells you, and I think we're going to a normalized environment, you want to start to look at some value stocks. The equity risk premium, everyone's talking about that, is very bearish. Right. It's the lowest it's been since 2000, which was a generational buy for value, for international, for small caps, et cetera. So I think we're going to have some opportunities there.
I got 30 seconds to go. I want to know, you use the word normal. I'm hearing normal a lot, normalized. What does that mean, normal? What is a normal bond yield?
Yeah, I think people overestimated us taking the terminal rate down to 2.5, down to inflation.
We're going to just simply go right back.
Yeah, I think, if you look at the late 90s, 3.5–4% is a reasonable place where you can have economic growth. It will be non-contractionary, and that's the right sweet spot when you have demand.
What do you like here? I'm rushing you because we're running past the time, but we've got to get some jewels from you because you're rocking, and now people want to know what to buy.
Turnaround Tom likes Advanced Auto Parts. This is the...
Oh, no!
This is the worst run auto retailing business.
I did a special on this bad boy.
But they've got Shane O'Kelly. He came from HD Supply. He sold off the Canada business, paid down debt. That's the number one thing in a turnaround, is that you have solvency risk off the table, closing the unprofitable, disparate shops on the West Coast, focusing on the areas where he's number one and number two, targeting margins that imply $630 million operating income by 2027. Last time it had $630 million operating income, last 4 times, stock trade between $180 and $240. It's a $45 stock today. We like this over the next 2 to 3 years.
My man. We'll see you before 1 year from now, but we're definitely going to be watching.
I love it. Thank you so much.
See you, buddy.
Appreciate it.
All right, folks. We'll be right back.
And we're back. So thanks to Charles for that. And then want to thank Camille Smith for having me on CBS to talk about inflation before the inflation report. Here we go.
Consumer Price Index report released this morning as the country remains on inflation watch. Economists are forecasting December's CPI to rise 0.3%. Today's data will figure into the Fed's interest rate decision, which could impact short-term loans. If numbers come in lower, we may see relief on the auto and mortgage front, but people shouldn't be deterred from borrowing.
At some point, you have to get on with your life. What we're seeing is we have had 100 basis points a cut by the Fed. That's going to be more effective as it relates to shorter term loans. You're seeing it already in a lot of auto incentives. It has less importance as it relates to mortgage rates, because mortgage rates are longer duration loans that's usually priced off the yield of the 10-year.
The CPI report will come out at 8:30 this morning.
And we're back. So quotes of the week. Peter Thiel, the most contrarian thing of all is not to oppose the crowd, but to actually think for yourself. And sometimes going with the crowd is absolutely right. And sometimes, particularly at turning points, you have to have some internal fortitude to flip the other way. And the more and more biographies you read of people who have been very, very successful throughout the ages, going into the 19th century, the 20th century, the common denominator is usually, if they didn't invent something, they bought assets when they were out of favor. That just is invariably the case. They didn't buy assets on breakouts. They didn't buy assets when they were trading at 50 times sales. They were sellers of assets at those levels, but not buyers. So Charlie Munger, a lot of people with high IQs are terrible investors because they've got terrible temperaments. Look, we cover that a lot on this podcast, and that's why a lot of very wealthy people allocate to me, is because the characteristics that make someone successful as an entrepreneur, make someone very successful in business, are very different than the characteristics that make someone successful in investing. In that, in the business world, massive action equals massive results. The more you do, the more you get. The more relentless you are, the more activity you have in the pipeline, the more business you do, the more money you make. In investing, it's the discipline to do as little as possible. So massive inaction equals massive results. Like Charlie Munger used to say, sit on your hands, buy a good business at a good price and sit on your hands. And that takes a lot of fortitude, because you're not just sitting there twiddling your thumbs. You're consistently researching, you're consistently testing your theses, you're consistently looking at competition, you're consistently reading the transcripts, doing channel checks, etc., while you sit there. And that's where the rewards start to come. Whether it's Comstock Resources, which was kind of interesting. I was thinking about, just looking at a couple of these things that are starting to move here. This one is over a double, getting close to being a triple. And I had someone reach out and say, why don't we sell that? And the answer is because we enter a business, an own a piece of a business when there is a meaningful margin of safety and we can make at least a double and in many cases a multi-bagger over a reasonable amount of time. And we know what intrinsic value is and where we're willing to get out before we even get in, and we're nowhere near intrinsic value. So when we added the PV10, the proved reserves that they have to report to the SEC, and our analysis of the unproved reserves, which is materially more, we don't get anywhere near. And then Bernstein was out, thanks to my buddy Alan for sending over, calling for a natural gas super cycle. And this looks a lot like the early 2000s, where you had this breakout and then and it just got started and the thing went from 20 to 400. I'm not saying we're going to that level at all. We'd be out a lot sooner than that anyway, or at least with part of the position. We don't buy it all at once and we don't sell it all at once. We always keep a flyer on in case it goes as irrationally to the upside as it does to the downside, because we want to participate. But that's well after we've taken all of our money off the table and a ton of profits off the table, and then we just have a flyer to catch these ridiculous parabolic moves at the end. But, and then you even look at VF Corp, which you couldn't give away. And, here we are buying 3 pairs of Vans, buying, 30 some odd pairs of Vans for the clients for Christmas and everything else. And, here's one. I remember being on the Clayman Countdown last year with John Najarian talking about VF Corp when it was at $13, $14 and, getting a look like... like I had leprosy or something, a look of disbelief. But now we're at $23, so, up some 50+%. And the story is literally just getting started. Bracken Darrell's a winner. You put $1 million with him at Logitech when it was down 82% when he joined in 2013. And stock was down from 26 down to 5. And, this was a 26 bagger. You made $26 million over the next 10 years. So that's kind of interesting. These are the things that we do. This is our calling in life, and we just rinse, repeat over and over and over. So, okay, getting back to it. The other thing I want to cover is the implied interest rate cut odds since the inflation numbers came out. And these have improved pretty materially. Now looking at a 63% chance of the first cut coming in June, which going into the inflation report, starting the year, as expectations dropped, okay, people were basically saying no cuts and starting to talk about hikes. It always swings to the extreme. If you remember a year or so ago, they expected 6 cuts. They always overshoot. So this year they started the year expecting, basically no cuts a week ago, and some people were calling for hikes. So now we're back to 63% chance in June, which implies 2 cuts for the year. You had Waller on this morning on CNBC singing the same song, and you had Goolsbee as well, and this would imply 1 in June, maybe 1 in October for 2 cuts for the year. That takes the Fed funds rate down to 375. And that's probably the terminal rate. And that is beautiful. That probably gets a high 5 handle on the 30-year mortgage, which absolutely skyrockets the home building business and all ancillary related businesses like Stanley Black & Decker and many others. So that's that. Now, want to go through some charts here. Talk about where we are with the general market. A couple here that stand out. I would say this NYSI oversold. This is usually where you start to see some bounces. and we saw some recovery yesterday, a little bit of follow through so far today, minus United Healthcare. Also, the NASDAQ McClellan oscillator, less oversold than the NYSE. That makes a lot of sense based on the things that we've been saying in the last few weeks. Here is the S&P 500 bullish percent down to 40% on a point and figure buy signal. You don't need to know what that is. All you need to know is what happens to the market when these get at or near these extreme levels. And the answer is you usually get a bounce. Pring emerging market diffusion indicator. Not only do you get a bounce in emerging markets, you tend to get a bounce in the S&P also when this gets oversold. And then PMO by SPX is coming off the boil, got down to 12% on PMO crossover. All that is like a moving average convergence divergence crossover, which is, it is what it is. Anyway, it's moving in the right direction. PMO by Dow Jones Industrial starting to come off the boil, got down below 15 up to 30. So these are things that point to some level of recovery here in the first quarter after the December and early January pause. S&P McClellan Summation Index, again, these are levels where you tend to get bounces in the S&P when it gets this extreme below negative 400. So we like that. NASDAQ intermediate term momentum oscillator, again, oversold. So, these are just barometers. They're not foolproof. Dow intermediate term breadth momentum, same thing. You get below negative 50, these things tend to bounce, and so on. Just putting things in perspective. Real estate looks oversold here. It got to 30% above their 200-day exponential moving average. Again, that tends to be bounce level. PMO by all got down to 5%. It's bouncing off that. I don't know where that went. But so we like that. Then this, you can't make this stuff up, but CLSA, I guess that's an Asian bank, in-house proprietary model projects a 40% rally in the Hang Seng Index this year. From their lips to God's ear. Let's look at the basis of this comprehensive analysis. Quote, secret hissings point towards good rises in the market through the spring and winter, a long period of summerish lassitude and small falls throughout the year. For ophiophiles and lovers of other slithery critters, we've pegged each month to a different species of snake and see them sloughing off their skins to reveal, like Russian dolls, the true inner snake of the Hang Seng Index. 2025 Feng Shui Index is now out. The wood snake's gonna be epic for Chinese markets. Okay, so this is a real bank putting out an analysis of the Hang Seng on the basis of Year of the Snake. You can't make this up. So whatever works, the comedic nature of investing in China as it has been probably supports that this is the catalyst that finally makes the trade work because fundamentals have not mattered. But leaving that aside, it's good to have some fun with this stuff. Let's get down to business here. A ton of data. Realized and consensus EPS growth for select U.S. indices. This is the Russell 2000, and I've been talking about 21% earnings growth for the small caps. What was that based on? That was based on the S&P 600 index, which is more profitable based on the composition. The regular Russell 2000 has more companies that are losing money, which is always the case at massive inflection points for small caps, just like the early 2000s, when you had record companies losing money before you had the biggest 7-year run in history. And the same thing is true for this year. So if you look at the Russell versus the S&P 600, which I've been using because it's more conservative and sounds more realistic, the Russell is expected to have 44% earnings growth next year, trading at 16 times versus the S&P 500, 13% earnings growth, equal weight, 13% earnings growth, NASDAQ 100, 21% earnings growth. So double the earnings growth, half the multiple. Pretty exciting stuff. This is from the Fed Whisperer. Nick Timmeros confirming what we said, now looking at 2 rate cuts. This shows rising interest rates pressuring stocks. You can see all of these spikes, and we believe this is a temporary third spike. Led to weakness in the stock market, and then yields rolled over and the stock market recovered. We expect the same thing this time. The other reason I had this chart up is I wanted to show you the US dollar, because we've talked about it in Trump 1.0. It's kind of eerily similar. Whether you look at the early 2000s, which we've used as a point of reference for quite some time, where you had this kind of rally in the dollar and then a little bit of consolidation and then a final peak, double peak top, and then a complete rollover back down to where it started. Or if you're less bearish on the dollar and you look at the Trump bump, huge rally into the Trump election here, as we've seen in the last 2 years. Then you get this final peak after the election into the inauguration, and then you get a rollover for the next year. That's when Chinese stocks went absolutely bananas. As a reminder, the only Chinese stock we care about in the year of the snake is BABA, and you can see what happened. You had this same build up into the election, then in anticipation of the inauguration, huge sell-off for 3-4 months, and then straight up parabolic move from 84 to 200 and change, which is why we were opened up to new money early. And congratulations, by the way, already a handful of new people came in. Congratulations on that. And we're going to close out on Friday, at the end of this week. Friday, Saturday, Sunday. It doesn't matter. Before the inauguration, and get that money deployed ahead of time, which is pretty exciting for those folks. So congratulations on that. And then, so this is that. We also talk about it in the context of the dollar. 2 things that are setting up perfectly, just like last few times. This is combined return. So basically, we came into this week, into the inflation print, with the expectation of 0 cuts this year. You had 5 straight weeks of losses for both the stock market and treasuries. That is now flipping on its head and turning pretty abruptly the last 2 days, which is exciting to see. And then here is the bond yield cycle composite. Okay, the bond yield cycle composite in 2025. This is from Leuthold. Their kind of case we covered last week was that yields rise until February and then roll over. I think it's going to be sooner than that. I think a better analog is probably what happened in Trump 1.0, where they started to roll over right after the inauguration, maybe even a little bit before, which is what we're seeing now. Citigroup Economic Surprise Index turning back up. Pretty exciting to see. Concentration of S&P market cap and earnings in the 10 largest index constituents. So you haven't seen this level of divergence between share of the S&P market cap relative to share of S&P earnings. So you got a spread here. You got 39% of the market cap, but only 28% of the earnings, which has been a multiple expansion story, aggressive multiple expansion story. And honestly, the last time you saw anything like that was in 2000, when you had 27% market cap and only 20% of the earnings. And you know what happened next? In that instance, tech crashed for the next few years. I don't think we're going to crash on tech. And by the way, while tech was crashing, if you own value, small cap, and international, you made so much money you could smile so wide and eat 4 bananas sideways. That's really what was happening from 2000 to 2007. So I think it'll be a more muted scenario where you get consolidation in this, but you do get a reversion back to market cap share reverting back to earnings growth. So either earnings growth needs to move, they need to cover 40% of 40% earnings of the S&P and stay 40% of the market cap, which is not happening. Their earnings growth is decelerating from 33% now to 18%, not 21%, the Mag 7. So be careful if you are overweight, and you may be more overweight than you think, not knowing it, because you own the S&P 500, which is 40% in Mag 7. So that's pretty aggressive. Spending growth for clothing up 8.5% month on month was strong in December. Clothing, we also have cold weather, so that should be helpful for Goose. I'm seeing a lot of Vans around here now. I am in California now, so I guess you're born wearing Vans in California. Have to keep channel checking every time I go back to New York each month. Households are very optimistic about the U.S. economy. That's since the election. That's very constructive. Actually, before the election a little bit here, so that's good. Wage growth has converged for all income cohorts. Growth remains solid, up 3%, so that's good. The lower income is starting to catch up to the higher income growth. Consumers continue to show solid momentum with spending up 2.2% in December, so that's going to bode well for earnings. Earnings expectations are pretty high at 11% and change. And then you've got China, record U.S. minus China real yield spread. Historically, this has been the times that you wanted to be an owner of China stocks, whether it's late 2008, early 2009. We also got close there in that 2016 to 2017 period, 2010, 2011, and then the early 2000s. So, just looking at all these things, the weight of the evidence, these are not foolproof indicators, if this, then that, which is why in the history of mankind, there's been only one person that beat the market using computers, which is Renaissance technology. And there was another factor. It's not just machine learning and all that. It's what questions do you ask? And if there's not the proper market framework and history to ask the right questions, it's just like putting the right prompts into GPT. You don't wind up with the right outcome. And so that's that. Moving along, USD investment grade bond maturity wall. 2025 is subdued maturities. 26, it picks up a little bit. 27, and then it goes back down. The biggest maturities are 2045 and beyond. Euro investment grade bond market maturity wall picks up next year. US dollar high yield bond market big maturity wall in 2028, 2029. 2025, not much matures. So they got it all refinanced during COVID, which is awesome. That's very, very good for the markets. So this is kind of the year where it might start to get a little shaky, 2027. Euro high yield bond market hits the maturity wall also in 2028. So keep an eye on that. But if rates go down this year, a lot of them can refinance if the market's open. Business bankruptcy filings per capita, people have been talking about this to spike back up. It hasn't even got back up to pre-pandemic levels, and it already looks like it's rolling over. So far, so good. This is a key chart that we've continued to remind you to pay close attention to, which is the Japanese government bond yield. Continues to climb higher, which is why you've seen such a hit to the Nvidias, the Palantirs, the Mag 7 of late. This is the carry trade unwind. This is all the free money that's poured into those concentrated stocks. Was a quote unquote risk-free return because you had no cost of capital. Now it's a return-free risk. It's amazing how that flips on its head. This is a note from Bank of America. Concentration risk for stocks. Denmark's stock market is down 20% since September, driven by Novo Nordisk, was about 60% of the stock market. Do you all remember when I was on Yahoo Finance, when there was the absolute mania about the GLP-1s, and it was a segment called goodbye or goodbye. So what's something to buy and what's something to say goodbye to? And I talked about, it was a healthcare theme. I talked about buy Baxter and sell or lighten up on Eli Lilly. Okay, Eli Lilly's coming a little bit materially, and the Baxter hasn't moved yet, but Baxter's going to move because they're going to sell off. They're going to get the $3 billion. They're going to pay down that interest rate, going to go down, and you're going to get a multiple re-rating because they're selling off the slow growth kidney business that compressed the multiple, and then the remaining business has higher growth, and then you're going to get a re-rating back to 16, 17, 18 times, and you get a stock that shoots from 40 to 60 pretty quick. So what they're saying here is best reminder of, so 2 points I wanted to make on that. One was that if you think, people felt that there was no competition coming from Ozempic and Zepbound, et cetera, the Lilly GLP-1s, the competition came, more competition has come, more competition is coming. So that is the same thing. You will see the exact same thing with NVIDIA. Okay, for those of you who weren't even through puberty, the last major semiconductor cycles, I can assure you competition is coming for NVIDIA, and the margins will contract and the spend will be reduced as we move from the large language model phase of AI to the inference phase, which takes a lot less horsepower than the heavy lift, which is the large language model, which is what we've been going through. And all you need to do is look at the CapEx plans for big tech, materially lower spend this year than last year, and that will continue to go down as they continue to see that the return on invested capital is de minimis. They are making the investments, not getting the returns, and that's why you're seeing Microsoft announced this week cutting 5% of staff. Facebook this week announced cutting 5% of staff, and you're going to start to see more and more headlines because they got all this spend and they got no return from the spend. So they're going to look for cheaper ways to retain share. They don't want to cede potential share to their competitors, but do it in a way where the bleeding in the short term is containable until the realization of what everyone's expecting, which will come true. It'll just happen many years further out than we expect. Just like Amazon in 2000, everything that we thought Amazon would change in the world, they've done. It just, you were paying for 100% of that happening in 2000 when it actually realized by 2015. So in the interim, because you paid for guaranteed outcome that wouldn't come till 15 years later, you had a 90% drawdown in the short term, even though you were right about the story. Price is what you pay, value is what you get. You paid too much for what had not yet happened. So the stock had to go down 90% and then take 10 years to recover and fulfill on the promise of what's happening. And we see this every single time, whether it's going to be the GLP-1s that are going to get hit with competition, or NVIDIA that's going to get hit with competition. All the beautiful things that AI and the GLP-1s are doing will probably happen. It'll just, in the case of the AI, it will take a little longer than expected, and you're already paying more than what that value is worth. And in the case of GLP-1s, it's just going to be a competition fest, race to the bottom. But more and more people will use it, which will offset some of that, which is a good thing. So here's what she's saying. Note, Magnificent Seven stocks have contributed 57% of S&P return in 2024, have a combined weight index of 34%, currently up to 38% of client equity portfolio. And most investors see AI bubble as biggest upside risk. best play to hedge U.S. concentration risk, increase international stock exposure in UK, EU, and China, which outperformed the U.S. in 2024, and long despised euro and Chinese yuan after the tariff announcements. This is brilliance from Michael Hartnett, who is one of the best sell-side analysts in the business. I love his contrarian writings. AI bubble. Okay, so best hedge, increase international stock exposure in the UK, EU, and China. We love that call. And buy the euro and the Chinese yuan after the tariff announcements. Absolutely love it. Here's what else he said. Doge plus nominal GDP boom plus creative debt management, e.g. Trump taps $35 trillion in home equity via a new GSE to help pay off $36 trillion of U.S. debt, causes U.S. budget deficit as a percentage of GDP to fall towards 3%. U.S. 10-year Treasury falls below 3%. Very risk positive. Best play long the 30-year Treasury. This guy is like, singing the same song. I love this thesis. This is a new mix on it, but if they did something around the mortgages with all the equity and that became spending firepower, we could see nominal growth, which is what I've said. The only way they're going to get the debt to GDP down is run nominal growth super hot, run inflation slightly above trend, plus 3%. And if they do that, $36 trillion in new spend into the economy from home equity, that could be monstrous. And that wasn't something on my bingo card, but keeping an open mind. Biggest inflow to cash since April 20th. Of course, that happened right before the reversal. Bull bear indicator at bearish levels, not near top levels. Moving on, Japanese 10-year government bond yield. This is the unwind of the carry trade. For those of you guys who don't know what I'm talking about, go look at an S&P chart for the first 1 or 2 weeks of August last year, when the Bank of Japan decided to hike rates, and which is basically unwind the carry trade, hurt people with leverage on that trade, and then they had to walk it back after you saw what happened with the market. More of that to come. They have no choice. Inflation is ramping back up in China. They're going to continue to hike against weak demographics, and it's going to be a bad thing. And then you're going to see all that hot money that was Asia focused, that used Japan as a false safe haven during the China downturn. As China turns up, all that money is going to shoot out of there and shoot out of India like it's going out of style. India is overvalued right now, and it's all going to go into China. Chinese 10-year government bond yield starting to move up. That's a positive sign. We want to see their currency go up and the yields go up. This is a sign of everything else moving. If you look at every cycle, we've covered that a million times. PBOC halts bond buying to defend yuan as economic gloom worsens. Headline from Bloomberg, of course, with that character about it. This is the US dollar, Chinese yuan. Here's what's interesting, ladies and gentlemen. Look how much the dollar has appreciated against the Chinese yuan. This is not by accident. This is exactly what they did in 2016, 2017 when Trump was threatening tariffs. It's like they're like, oh, okay, you want to tariff us 20%? We'll just devalue our currency by 20% and call it a day. And this time is no different. It's kind of comical, but they go through this dance, and it's good for political headlines, and but it has no net effect. Dollar yuan exchange rate. Here's the 30-year historical. Look, ladies and gentlemen, I just pointed it out to you here visually, so you could see we've seen this same silly movie before, right up to January 23rd, which was the inauguration, January 2017. There's the inauguration. You had this weakness in the yuan. And then as soon as the inauguration, yuan rolls, dollar rolls over, yuan strengthens, and Chinese equities take off. Same exact playbook. I mean, It's comical. Small is less than 4% of the U.S. equity market. These are extremes that you saw last in 2000, then back in 73. Remember, I've talked in the 70s, all the value guys made their billions, like Cooperman, Gabelli, Buffett, etc., even though the market did nothing for 12 years. These are the times where fortunes are made, ladies and gentlemen. Buffett got started in the 50s here. This was the exact same environment. Ben Graham here in the 30s. When this is like this is when we make so much money. It's insane. And these inflection points are where fortunes are made. So just keep your eye on the prize. Total unrealized gain loss as a percentage of bank equity capital. So there's still upside down on the bonds. It's something worth keeping an eye on. We've had a huge run first and foremost, we had a huge run in the BAC in the city, which we took off last summer. It's now moved up a little bit after earnings. We still own the regional bank basket that we bought during the mini banking crisis with SVB in, I think it was March 2023. That's up, I think, about double now, and we're probably going to get a little more juice out of that before we start to peel it off. I think there's probably another 20% in it, but that's where it is. U.S. Treasuries entering 6th year of third great bond bear market in the past 24 years. Ladies and gentlemen, here's the recency bias that rates are going to keep going up like they did in 1980. Here's the reality. Since 1790, these are normal spikes before rollovers, You had one by the way, very interesting, ladies and gentlemen. If you read a history book, it's amazing what it can tell you potentially about the future. The last spike up we had like this that wasn't 1980 was right after what? The Spanish flu. Right after 1918 to the early 20s, you had this initial spike up because of the supply chain disruptions and other similar characteristics to what we had here. And then you had a rollover for the next, all the way to 1948. So from, call it 1920, 18 years. I'm not saying that's going to repeat per se, but these abrupt spikes caused by exogenous events are more the rule than the exception. You had a similar situation in 1859, then in 1837, and then in 1795. So that is more likely. And by the way, if you take out this one exception, you could draw a downtrend line. It's kind of interesting. U.S. 10-year break-even rate. So inflation expectations had shot up ahead of the inflation reports this week. That's now probably rolled over, just like the cut expectations have rolled over. China's CPI year on year spiked up, rolled back, so it's still positive. They continue to say it's deflation, but you still have positive prints. CPI year on year is also turning back up. PPI turning up. That's a leading indicator, not a lagging indicator. Then you've got China net purchases by assets. This shows, very interesting, their purchases of U.S. government, corporate, federal agency bonds, corporate stocks, foreign bonds, corporate bonds, and treasury bonds and notes. And you have not seen this type of negative purchases by the Chinese of these assets since those areas preceding the last 5 rallies in Chinese equities. So they kept their powder dry and probably reallocated to the Chinese equity. So last time you saw it was 2001, preceding a monster rally in Chinese equities. 2008, another monster rally. 2012, same thing. 2017, 16 into 17, last time you saw this, boom. Same thing in early 2020, and then boom. These were all preceding major rallies in China equities. So, India's world-beating economic growth is moderating. I would be not allocating any money to India right now. That money is going to go into China, and it's going to do it fast, along with the Japanese money. Here's the copper to gold ratio. Again, this is what you saw in late 2016, early 2017, which precedes what? Major rallies in China economy. Every single time this got down to this level, early 2000s, 2008, it preceded a monster recovery in China economy and China stocks. So market cap of the largest stock relative to the 75th percentile stock weight of the top 10 stocks in the S&P 500. So I continue to just reemphasize this. These are concentration risks that we haven't seen since Great Financial Crisis, dot-com bubble, Nifty 50, Great Depression, etc. If you are in the concentrated stocks, I think you are not going to be happy. So you don't have to get out of all of them. I think they'll do okay. I just think they're going to do a lot less well because this concentration risk is going to disperse as the rest of the market with earnings growth acceleration takes over share from the concentrated part that has earnings growth deceleration down from 33 last year to 18 this year, but the multiple has not yet re-rated. I think that's coming, ladies and gentlemen. The copper gold ratio, same story here relative to the 10-year treasury yield. I think this meets in the middle. I think the 10-year treasury yield rolls over, and I think the copper gold accelerates just like we saw preceding those rallies in 2017, 2020, 2012, and 2008 in China equities. So just cutting at it from a million different ways, all point to the same thing, but nothing more important than the year of the snake and the silly calendar from CLSA. A record number of U.S. companies changed their CEOs last year, which gave us what? Opportunity, manna from heaven for turnaround Tom, easy pickings to find unbelievable opportunities, which is usually one of the key catalysts after we get through solvency risk, after we get through buying it at a price that would insult the board. We look for catalyst for change, and usually in a turnaround situation, the catalyst for change is going to be a new CEO, whether it's Bracken Darrell at VFC. Some of them are just cyclical and you have to wait out, like Cooper Standard. Baba got a new CEO, and on and on. So moving along. 10-year government bond yield. Again, I think this peaked out here this week. Same with 30. We went through this chart. S&P erases post-election rally. This is kind of interesting what happened. And if you actually did equal weight, probably even more so, that was an abrupt pause in December, which is going to refresh moving forward. Performance of global renewables and ESG favorites. Absolute terrible. There's probably some opportunity there. Actual S&P earnings growth has exceeded expectations in the last few years. So we're expecting 8% earnings growth this quarter. Is probably going to come in 11 or 12. And then this continues to ramp up 11%, 11%, 15%, and 17%. We'll see how that holds up. Concentration, we covered that. Here is the Fed's model. Valuation edge evaporates as bond yields spike. This is critical, ladies and gentlemen. People are talking about the equity risk premium being so low, earnings yield minus 10-year treasury yield, as bearish, meaning expected returns for the next 10 years. You're getting all these people coming back out talking about the next lost decade as they were for the last decade. What this points to, how this got so skewed, is the multiples of the Mag 7, which have not yet re-rated down, consistent with their earnings deceleration being derated down. And that creates the opportunity of a lifetime for the 493, for emerging markets, for international, for small caps, that will benefit from the re-rating of the concentrated, which has brought the equity risk premium down. So the equity risk premium is probably at the worst point that it's been in 25 years if you own those concentrated basket of stocks. And it couldn't be better if you're buying in the areas that we're buying, which is why we have such a low correlation to the overall S&P, and that's a good thing right now. What do you think the return on the S&P 500 will be in 2025? The bulk of folks pointed to 5 to 10%. I think that's reasonable. That goes back to what Peter Thiel said. You don't have to be a contrarian. I happen to agree with consensus right now. And then you've got the tails around 0 to 5 and 10 to 15. And I think anywhere in that range of, call it 8 to 12% is a reasonable expectation, because I don't think that concentrated basket's going to do well. And even if the rest of the basket does exceptionally well, which we think it will, it won't be reflected because of the current small weights. This reminds me of the period in 2020 when energy got down to like 2% of the S&P weight, down from 8 or 9 or 10. And every week I'd go on when we were buying Exxon at $33 or whatever it was, pounding the table like, this is not going to continue, ladies and gentlemen. Everything that you use has energy in it, in addition to your car. And sure enough, that was just a monster home run. S&P 500 concentration median PE, again, nothing like this, going all the way back to the .com top and the Nifty 50. US has a valuation at its 20-year peak, and this remains true even if we exclude the largest technology companies, which is why we like the international, we like the small cap, we like everything setting up here. Whereas China is on the low end of its historic valuation. You can't give away China. People can't get enough. What was the note this week from Goldman? U.S. exceptionalism to continue, only buy U.S. stocks. Well, last year what they said was they were the lowest target on the street at 5,400 for 2024, and they were 100% wrong. They were basically implying no gains in 2024. They got it wrong. This year they're saying crowd into what's already risen, and they're going to be wrong again. S&P 500 quarterly EPS forecast. So you can see here 13% next year. Interest rate cutting cycles have generally been associated with rising equity prices so long as a recession is avoided. We believe a recession already happened in 2022. They tend to happen every 4.1 years, which means we front-loaded 8.2 years of recessions into 2 years between 2020 and 22, which should imply we've got another 4+ years, 6 total from the last recession to potentially be recession-free. We will keep an eye on the data, but when you have GDP estimates 2.5 to 3 consistently coming out and earnings growth in the double digits, very hard to have a recession, ladies and gentlemen. So in that case, with no recession, we could be seeing some materially improved and positive equity prices. Realized and consensus EPS growth for Select, we covered that. Citigroup Economic Surprise Index turning back up. That's good. Here are the charts. So as you can see, oh, interesting. My bad, ladies and gentlemen. Wall Street's 2024 year-end price targets, Goldman was not at 5,400. Goldman was at 5,100. No, that was 2023. Okay, so they were 5,400 for 2024. Here are the growth versus value. Just a friendly reminder, ladies and gentlemen, when conditions were set up the way that they are now, for the next 6 consecutive years from 2000 to 2006, value outperformed growth by 29% in 2000, 14% in 2022, 12% in 2023, 30 basis points in the next year, 10% in 2024, 1.8% in 2025, 13% in 2026. And that's the norm. This is the exception, zero interest rate policy. Then going back to the 80s when Reagan was in, most years value outperformed growth: 81, 83, 84, 86, 88. Growth relative to value, again, going back to the .com top. large caps to small caps, again, going back to the .com. So if you're not buying the right thing at these extremes, then you are, the way I would put it is, if you're not a student of history, you will miss a lot of the generational opportunities. And what a lot of smart business people do is they allocate people who do to people who do this for a living, that see these things and that have the ice in their veins to sit through. This is not a easy period to sit through, but then you don't get the benefit of this regime change if you're unable to sit through. And the way that you're able to sit through is doing your work and having the confidence because you've done your work and you understand what's going on, and then being on low leverage so you can sit through the short-term volatility to the long-term rewards. You cannot have excess outperformance over time without short-term volatility. It's just the scales of justice. You got to trade one for the other. If you want excess outperformance in the long term, you have to have short-term volatility in the short term. And the way that you get through short-term volatility in the short term is, number one, you've done your work so you have confidence. And number two, low to no leverage. And if you have those two things in place, then you get the excess over time, which is what we try to do here, which is why we have such a low correlation to the S&P versus 99% of managers being closet indexers, charging you for something that you can get for free by being in index funds at the exact wrong time, when passive indexing has hit an all-time high, at the exact wrong time when concentration is at an all-time high, which every time it's done that, we know what happens next. So here is another chart from Charlie Bilello, not only doing the value versus growth, doing S&P 500 versus ex-US international stocks. And again, this ZERP environment has been the exception, not the rule. Exception, not the rule. So unless you believe we're going back to zero interest rate policy, you do not want to be overweight US relative to international. You do not want to be overweight growth relative to international. Now, does that flip in 2025 guaranteed? I think it probably does. Do we know if it's 2025, 2026, or 2027? We don't. But what we buy has a large enough margin of safety that we're perfectly comfortable taking the asymmetric trade now, because once it goes, it doesn't go like, oh, you get 1 year and a check back. It goes for streaks. 2002, international outperformed domestic 6.6%. 2003, 11.3%. 2004, 10% international better than US. 2005, 10% international better than US. 2006, 10% international better than US. 2007, international 7.4% better than US returns. And then early 90s, same thing. 80s, during 70s, basically the whole decade, 71, 72, 73, 74, while US was crashing, international was doing better. Same with 77, 78. And then during Reagan, second term, 85, 86, 87, 88, all meaningful outperformance. In 86, international outperformed US by 44%. These are not one-offs. These, when this turns, it turns and it doesn't look back for many, many years. Value versus growth. And as a friendly reminder, value has outperformed growth by 4.4% per year since 1927, including this zero interest rate policy aberration, where it's funny, I was joking with someone yesterday. They had this 10-year, they had this computer model that they thought they could beat the markets. And I said, well, how far does it back test? And they're like, well, only 10 years. I'm like, okay, well, in the last 10 years that you've predicated the model upon, let me tell you what's taken place, okay? Prior to the last 10 years, if you said to me, Tom, here's some money to manage. I'd like you to lose 90% of the money as fast as humanly possible. I would have said to you, that's so easy. Here's all I need to do. I'm going to buy a basket of 20 stocks that are all trading above 10 times sales and making no money. And I guarantee you, I will lose 90% of your money in 3 years. And every other decade prior to 2010, if you had bought a basket of 10, 20, 30 stocks, all trading at greater than 10 times sales, all making no money, you would have lost 90% of your money within a matter of a few years. So that is a guaranteed way to lose money. Except during the one decade in history when you had zero interest rate policy for the first time, that actually outperformed the S&P 500, losing money trading at 10 times sales. Okay, so 2022, when they all got roasted, and we were, buying Google in the hole in fall of 2022, buying Amazon in the hole in fall of 2022, and making easy doubles. Those folks got roasted. So that was a preview of coming attractions. When the carry trade unwinds, these folks are going to get shellacked. Okay, so what I can tell you is, beware of recency bias, because you will make false assumptions, deadly false assumptions, on the basis of what's happened in the short term, and what over a reasonable framework, when you zoom out, is guaranteed to cause permanent, irreversible damage. So that's that. Here's another thing for my folks over at in Cork's class, who I know listen every week. And I'm going to go speak to this group of students in early February. Here's what you have: the S&P to international stocks from 1970 to 2024. The U.S. performance is 3 standard deviations above the mean. So do you want to bet on it going to 4 standard deviations? Or do you want to play the reversion like in 2000 and 2001, like in 1984 under Reagan, like in 76, like in 70, where if you got out of the US when you were at this extreme and started to get some international exposure, you dramatically outperform for the next not 1, not 2, not 3, usually 5, 6, 7 consecutive years. I will take that asymmetry all day long. And I continue to say, for those getting started and those who have been with me, what COVID created is a once in 100-year opportunity, where it just, the opportunities that have created will not replicate in my lifetime in the way that they are from what we're seeing right now. And we are positioned to take advantage of them. Here's another way of looking: emerging markets to S&P. Again, going back. So there you go. Hiring blew past expectations with 256,000 jobs added in December. So that was the catalyst for people saying no cuts or hikes are coming in 2025, which will prove to be incorrect. Non-farm payrolls, the growth was in healthcare and social assistance. The contraction was in manufacturing. That is going to change under Trump. That also has something to do with automation and robotics, but we'll see how that plays out. Consumer sentiment index rose. Economic conditions rose. We got a lot of data this week. Inflation expectations rose after the jobs report. That's what hurt yields. That's changed after the PPI and CPI. PPI is a leading indicator. Here was the implied probability of a rate hike. You saw it spike up after December and January. That's now probably rolling over. Chinese trade surplus is at $1 trillion. That'll normalize as the yuan strengthens. Number of stocks in uptrends continues to dwindle. They say that like it's a bearish thing. That's usually a bullish thing, what you see closer to bottoms than tops. S&P 500 members greater than the 50-day moving average. Again, it's like a bearish thing. It's not a bearish thing. This is what you see at bottoms, like in the fall of 2023. Turning the corner with the cyclical rebound. This is from Bank of America. December likely marked the beginning of a cyclical rebound in manufacturing, which has been in a downturn for over 2 years, longest in history. With half of the S&P earnings tied to manufacturing, the cyclical rebound should lead to volume growth, driving better operational leverage and margins. 67% of companies are expected to post positive EPS growth similar to last quarter, but that is expected to improve to 95% by Q4 of 2025. Moreover, which is a record high. Moreover, albeit still slow, over 25% of companies are expected to outpace the Mag 7's earnings growth by Q3 2025 versus the low of 8%. That is huge, ladies and gentlemen. Let me repeat that. Over 25% of companies are expected to outpace the Mag 7's EPS growth by 3Q 2025 versus the low of 8%. So 3 times as many companies are going to outpace the S&P the Mag 7 earnings than did at the low just a short time ago. Consensus expects 9% earnings growth in the fourth quarter. We'll probably get 11%. You can see here where that is. Lightweight vehicle SAR versus domestic auto inventory. You can see here the inventories are still low. This looks very much like both the 2000 when Charlie made his fortune on Tenneco, which was the inspiration for our Cooper Standard trade. You get these collapses off of high levels and then these recoveries. And then 2009 is a closer example where you got this kind of double, absolute catastrophic collapse like we had during COVID. And then you start to take off a little check back before the absolute parabolic move up as inventories catch up to SAR. And that's where we are there. Durable goods orders minus motor vehicles versus inventory. Same type of thing you saw in 08 and 09 before a huge run in auto parts suppliers. Consensus expects 67% of companies to grow EPS year on year in Q4, same as Q3, but 95% by Q4 2025. 95% earnings of components growing earnings by Q4 of this year, which speaks to the broadening. Over a quarter of stocks are expected to outgrow EPS versus the Mag 7, up from 8% off the lows. So you can see these type of cycles. The last time you had it was the end of COVID, and then prior to that, 2017. And sure enough, you get the broadening coming back in a material way. Here's another way to look at it in terms of earnings. And here's another sector by sector. You can see here where the earnings growth is going to start to kick in materially is healthcare. Materials is going to be huge in the back half of next year. Industrials, huge back half of next year. Energy, all the things that you can't give away right now. So that's exciting. Here's the destock cycle to the restock cycle, just like in the early 2000s. Huge move up off the lows, then a check back, and then a final move. Same thing here. Semis and autos saw the biggest destocking year over year. So now we're into the restock cycle, build those inventories back up, get the incentives going, off to the races. CapEx growth just accelerated for non-Mag 7 for the first time since 3Q 2022. So that's a positive sign. And we were talking about that earlier. CEOs expecting higher CapEx over the next 6 months. So CEO confidence is coming back. Rail freight carloads still okay. Korean exports still okay. Those are leading indicators. This has been the most rate-sensitive manufacturing cycle in history. So you see it going all the way back to when? To 2001. And then straight up after that. And I think we're going to see a similar thing, which will be good for what? For value versus growth. January to February has seasonally been the weakest guidance period. So we'll see how that guidance plays out in coming weeks. Corporate sentiment remains strong. Corporate sentiment has historically led quarterly EPS growth by a quarter, so that's a good thing to see. Reporting by week, the biggest week is going to be the January 27th to the 31st, and then the first week of February. We're just ramping up. Moving into next week will be kind of like this week, but the big week is the week after that. Here is an update from Baxter. They spoke at the JP Morgan Healthcare Conference. Preliminary guidance anticipates sales growth of 4 to 5%, adjusted operating margin of 16.5%, restarting the North Cove facility, which was hit by the hurricane. And obviously, sale of the kidney business to Carlyle early 2025, Q1 2025, proceeds of about $3.2 billion to be used exclusively for debt reduction, reinvestment, and potential share buybacks. So that's going to be a catalyst for re-rating because the kidney business was the slowest grower. And as they get earnings growth back and debt deleveraging and interest expense down, we'll see a multiple expansion and get that stock off to the races, which is exciting. Moving along, small business optimism turning up, producer prices cooling, all things we want to see. That's a leading indicator. Buybacks, announced buybacks. What's the biggest sector? Is healthcare, energy, financials, and staples are having the biggest buybacks, whereas in backward looking, it had been tech. Here's from Seth Golden. One thing we should anticipate investors, traders from the high valuations is bigger pullbacks. When valuations in the 9 to 10% decile, top deciles correction probabilities increase sharply. 80% probability of a 10% correction, 98% of a 5% pullback. So yeah, and they're going to be concentrated in where those areas that you have concentration. Here's 52-week lows. This people look at as bearish. It's usually what you see near short-term bottoms. General roadmap for 2025. This is from Larry Williams, who's been pretty hot the last couple of years, up and down over the last 40, but he's been doing it for a while. This is his cycle analysis, which points to a little bit of weakness going into early February and then straight up through the rest of the year. We'll see if that proves to be correct. Here we go on the Slumer slides. We got 2 Slumer from RBC, thanks to my buddy over there. So it's showing momentum turning back up on the S&P, bond yields topping out, getting overbought, dollar topping out, losing momentum, all the things that we're talking about. Again, just a different way to look at it. These are the things you check yourself before you wreck yourself, you know? I mean, you look at every possible way to analyze and stress test your framework, and the more ways you can stress test it, the higher confidence level you can do. And then you always manage risk for something that you don't know, or a black swan. So no matter what happens, you live another day for the recovery and then the follow through and then the outsized returns over time. And that's the name of the game. Here is the S&P 500 bouncing after that inflation reports and then momentum turning up. Same thing with yields rolling over. Dollar, small caps and mid caps up against this trend line. Small caps breaking out is going to be the big story of 2025 in the US. That is, international outperforming is going to be the other big story that no one's prepared for. No one's even talking about preparing for. They've just forgotten all about international, which is the perfect time to be getting involved. Industrial is bouncing up. And then what do we have here? Smart money, buying and selling activities. This is what you see at lows on the indices. They've been selling in the hole, which is what they do every single time. Hedge funds are the most bullish on the dollar since 2019. We know what happens after they get overweight. You tend to get a reversal. Everyone's crowded into one side of the boat. After the 1973 Nifty 50 drawdown, the average stock recovered in half of the time. The ones that got smoked, that didn't recover for a long time, were the concentrated Nifty 50, the top handful of weights in that index. Took many years to recover, whereas the rest of the market recovered very, very quickly. Dollar sentiment index is at a high, at the same high that you see at all the previous peaks. Gold, after US dollar rally, sentiment exceeds, this is gold sentiment, so good luck with that. Instances where VIX one-day percentage change is greater than 60% and S&P 500 performance. So this is from Fundstrat. He's implying that the S&P could recover to 6,500 by mid-February based on this. I think this is tenuous, possible, but tenuous. Not enough of a data sample to draw strong confidence conclusions, but I think the direction is correct. And I think a lot of people were not positioned to that going into the inflation prints that started things moving in the right direction. And speaking of which, yeah, and today as well. That's exciting. All right, spreads as a percentage of yield are near record lows. These levels have not been seen since before the financial crisis. Look, this is what you see for many, many years. These are a trend. You can have hiccups like we saw in 2023, but this can last for many, many years. Spreads contract after having a heart attack like we saw in COVID 2020. I had a friend who was so bearish in 2022, and he basically sold everything in the hole. He didn't admit it, but that's what he did, because he said that this was going to spike right back up, and he showed me all these examples where it spiked right back up, and I said, that I'm telling you, this is the time to be buying, not selling. You know, market's already down 25%, buy everything. And he took the other side of the trade. So anyway, you just have to be burdened by history. None of these things are guaranteed. He could have been right, but the underlying fundamentals didn't support that view, and that's why we were buyers versus sellers in the hole. United States producers prices, final demand, less foods and energy. This is a collapse. I mean, this is good. This is a leading indicator as well. Hyperscaler, CapEx growth. This is what I was talking about, ladies and gentlemen. The annual CapEx growth is declining from 50% growth last year to 21% growth this year, which is coincident with the earnings growth deceleration. Next 12 months PE, okay, you can see mid caps versus 493 versus S&P versus small caps. We've covered annual earnings growth. You could see here the Magnificent Seven in blue. Next is dropping from 33% down to 18%. S&P 493 is going from 3% last year to 11% this year to 13% next year, whereas Mag 7 is 33 last year, 18 this year, 16 next year. One's going up, one's going down. Where do you want to be? Where do you think you're going to see multiple contraction? Where do you think you're going to see multiple expansion? Can't reemphasize this enough. And I haven't reemphasized this enough. Only 50 times every week for the last few weeks. Let's see here. Revenues, foreign revenues, exposure by sector. This is pretty interesting. The S&P 500 has 28% exposure. So you may see some short-term headwinds from the dollar being strong in Q4. That's something to keep in mind. That'll probably impact guidance as well, which is interesting because guidance is weakest in January and February. We covered this. Sensitivity of sales growth to changes in US dollar by sector. Number of months with consecutive payroll gains since 1939. With a positive December 2020, this cycle will move into the second longest period of consecutive job gains. Not stuff you generally see during a recession. We covered the household and service. You can see the Japanese topics breaking this, whatever they call this, a bear flag for all the technicians out there. This is key. Trump team studies gradual tariff hikes under emergency powers. This is a big deal, and the market liked this when this headline came out. Gradual versus all at once. That gives them leverage power. You know, if they go up 2% every month for 10 months, every month they ratchet up the heat, bring them to the table, so maybe they don't have to go to the full 20%. And the second thing that they talked about was targeting certain industries versus blanket, which is also a positive thing. You can tell Besant is hard at work providing a level of rationality. Rock bottom valuations imply plenty of upside when sentiment improves. This is emerging markets in Brazil. This one's particularly targeted at emerging markets in Brazil. Again, one more data point confirming what we've been talking about. The level of oversold which preceded every single previous massive rally in emerging markets and Brazil. Equal weight versus S&P 500 bottoming and turning up. This is a positive thing, just like we saw in the summer. That happened. That continued all the way till December. Then we took a break. Now we're recovering. Traders brace for biggest S&P earnings day reactions ever. S&P 600 around election days. So this has been weaker than normal. I think we'll get a catch up on the S&P 600. Here's the Russell 2000 down to its 50-day moving average, ready to bounce off. We think that's imminent. Stocks have been riding a wave of liquidity. You can see how that targets there. I think that liquidity is going to be a function of the Japanese carry trade, which when that the air starts to come out, the air is going to come out of the concentrated stocks we've talked about. Stocks have historically done better under re-elected presidents early in their second terms. So average return is 9.6%, which I think is right in the sweet spot of what we're looking for the indices this year. I think we're going to see fortunes in the non-indices this year, and I think we're set up extremely well for that. PPI, truckload, Bank of America truckload demand indicator versus ISM. Truckloads turning up, predictive of ISM manufacturing turning up, predictive of everything else that we've been talking about. Consensus on the bonds is too bearish. Contrarily, not supported a further rise in bond yields. Small retailer sentiment on treasury bonds selling in the hole, just like they do on every single turning point. Once you got the retail sentiment super bearish on bonds, that's when you get the recovery, and you can see it looking back to 2015. Same thing with the dollar. Consensus dollar is too bullish, contrarily not supportive of a further rise in the dollar. Who's hand over fist bullish? Hedge funds and small retailer traders are more bullish on the dollar than they've ever been, which points to a rollover. Small business optimism index taking off. You can see the stocks losing momentum due to dollar strength. Well, dollar is now going to weaken, which is going to be good for equities. And then tech position is vulnerable as it again significantly above levels implied by earnings growth, with a gap similar to that seen in early July ahead of the Q2 earnings season, right before we had the rotation. So again, another way to look at the same thing that we're looking at. Check yourself before you wreck yourself. Cross-check everything. Here's TLT, and what you see is bond market shorts are about to get squeezed. Rally in bonds is bullish for stocks. So you can see here this level of extreme not seen for many years, and which preceded rallies, or at least short-term bounce backs, but definitely rallies in bonds and TLT. Short interest is at all-time highs, and these folks are going to get their Tuchus's squeeze city. Goldman Sachs chief economist expects Trump to slap 20% extra tariffs on most Chinese goods on average only, not the 60% as advertised. Intel stock has been beaten down. How a new CEO could shake things up. They also are separating their venture capital arm. That's been a division since 1991. Can Doge really slash $2 trillion? Musk is now talking about $1 trillion. Which is good from both an inflation and a deflation standpoint. 2 trillion might have been deflationary, 1 trillion is the right number. China's central bank beefs up support of the yuan near 16-month low. Same thing at 2017, which we covered. Hershey seeks new CEO with Michelle Buck departing next year. That is a positive catalyst. We have our eye on that stock. We've done nothing yet. Jeff Sika, I met Jeff in the green room for Charles Payne. Really nice guy, real estate guy. Or private equity, real estate, or something along those lines. Anyway, I thought this headline was great. He said Trump should declare California an opportunity zone, give tax incentives to rebuild and rebuild quickly. I like that idea. I think it's brilliant. The bull market is still intact. This pullback is just the cost of doing business, says the strategist. We agree. Trump team studies gradual tariff hikes under emerging powers, boost duties 2 to 5% a month on trade partners. Supporters include Besant, Hazlitt, and Moran. This is really, really important because that'll get people to the table before you get up to 20%. An out-of-the-box idea for China and Trump. This is from the FT. They usually are not full of good ideas, but this week they were, from Mark Sobel. And what they're talking about was that the Chinese and the U.S. should get together to defend and strengthen the yuan, and which would weaken the dollar and have a win-win situation and help them come. I think it's actually a really clever idea. The title of the article is an out-of-the-box idea for China and Trump. China will do it on its own, but I think with implicit approval from the U.S., it would go a lot better and a lot quicker, which supports what we're set up for. Investors pour billions into S&P equal weight fund as tech fears rise. Sometimes it's good to be with the crowd versus against it, so they're getting on board. Treasury yields dollar fall following December inflation data. Accidents waiting to happen in private credit, says Welcome Trust. I agree with this. You know, the thing about private equity and private credit is these instruments were designed for pension consultants to keep their jobs. So the good news about private credit and private equity is there is no mark to market. So it's marked to make believe. It's marked to whatever the purveyor of the funds decides that it's worth. So effectively, they mark it to full value until and unless they take an impairment. And when they take an impairment, it's usually not 10%, it's usually 100%. The beauty of public markets is you can see the mark to market on a day-to-day basis, and you can get a warning well ahead of advance, okay, to recheck your thesis in this. With this, you get perfect mark to markets, zero volatility, you sleep like a baby, and then you wake up and it's impaired down to zero. And I think you're going to see a lot of that in private credit, reckless lending, because they mark to, and the interesting thing is, unlike what we do, where we only get paid for performance, we don't charge a management fee. They're getting paid a management fee on what they market to. So what do you think they're going to market to? They're going to market to the highest value that they think that they can get away with until it gets marked down to zero. But after it gets marked down to zero, they don't pay back all the fees that they collected when it was marked to make believe. And I think the chickens are going to come home to roost on this. For everyone who's overweight private equity and private credit, good luck. China stocks rise on a report that Trump is considering a gradual approach to tariffs. We covered that. Joe Tsai says Alibaba imports $50 billion worth of U.S. goods annually to help cushion the trade deficit. So well said, Alibaba is pro-Trump. Microsoft pauses hiring in the U.S. consulting unit as part of a cost-cutting plan, memo says. Meta announces 5% cuts in preparation for an intense year. Intel to spin off venture capital arm as chipmaker continues to restructure. Odds of multiple rate cuts in 2025 are rising. 10-year Treasury pulls back aggressively after core inflation is light in December. Disney wins the 2024 box office as year-end receipts offer a welcome boost. Bonds have banner day as inflation report revives Fed cut bets. Chicago Fed president sees promising progress on inflation. Here's what he's concerned about. And top shelf stock market and sentiment results article of the week. We covered Diageo this week. And each week we try to cover one or two companies we previously discussed and or own for clients, including personally. And what I usually start with is a long-term chart, zoom out. What you can see is this is a long-term compounder that goes through cyclical troughs every 10 or so years, like you saw in 2000, in 2009, during COVID for a half a minute, and in 2024. But throughout all of that time, what you can consistently see is sales stay relatively strong, cash flow continues to stay strong, earnings continue to stay strong, and sales continue to grow. And what do? They reduce the share count, in this case in the last 10 years, by over 12%, from 688 million down to 602 million, which improves so even if they didn't grow sales or cash flow, the value to you, your piece of the pie, continues to get larger and larger and larger, even without putting excess new capital into it. And your total return on capital has consistently been in the mid double digits. This is a great compounding business with a moat. And the return on equity is in the 30s to 40s, but we care about total invested capital. Looking here at free cash flow, it's consistent with price movement. Again, growing free cash flow over time with a series of cyclical dips in between, with price dips along with those cyclical dips in cash flow, and then recovering. As you can see, Diageo is a story of cyclical downturns in the context of a long-term secular uptrend. Free cash flow dips and recovers every cycle. The one thing that has been consistent through the years is a high return on invested capital and a continued shrinking of the share count through buybacks. So, global industry leader. Here's the big thing that you need to know. Diageo is the number one player in terms of premiumization, which they think is a long-term tailwind to revenue and margins. We see long-term secular trend of consumers drinking less but better. This is the key theme, ladies and gentlemen. Drinking less but better, gradually leading to pricing growing ahead of volume in certain categories. So, first and foremost, by 2030, expects to increase global share of total beverage alcohol market to 6% from 4% currently, which implies 30 billion in extra servings being sold. This will require Diageo to continue to acquire small players. Strong innovation pipeline, affordable luxury category. Diageo has a strong presence in emerging markets where per capita consumption of alcoholic beverages is lower, providing a huge runway to growth. Huge emerging markets. So, what are the two worries about Diageo? One is China. What we're going to find out is that their China business is doing just fine. And two is GLP-1s, people no longer drinking. People are drinking. People will always drink. People will always want to escape. I don't think they're going to go out and drink 24 cans of beer on GLP-1s, but I do think they are going to get a $100 bottle of tequila when their friends are over and pull it out because it's an affordable luxury. It's, Diageo brands are a status symbol. So their market is not billionaires buying a $200 bottle of tequila. It's middle class and lower middle class people buying a $100 or $200 bottle of tequila as an affordable luxury to show off with their friends. And it's just like, why do people go to Starbucks and pay $10 for a cup of coffee? So they can walk around with the cup and say, I'm successful and I can afford Starbucks. Otherwise, they would just make it at home. If you took the label, that Starbucks girl off it and just served it in a coffee cup like you would get from a street vendor for 50 cents on the corner of 5th and 40th Street, Starbucks sales would probably drop 80% over the next 12 months. It's all about branding. It's all about affordable luxury. Take the Lululemon sticker off the leggings and their sales would drop 40%, 60% overnight along with their margin. Diageo, it's a branding story. And the other thing that's interesting is in most businesses, when you have obsolete inventory, you have to fire sale, mark it down to get it out. Diageo has this huge inventory, $7 billion of aged scotch and whiskey. And the older it gets, the more valuable it becomes. So if you look at Johnny Walker Black Label, 12 years, 15 years, 60-year-old malts, they continue to invest in this. And the older it gets, the higher the margin they can charge with no additional fixed costs, which is going to continue to grow. And if you're on GLP-1s, which, by the way, the vast majority of the emerging markets is not going to be anytime soon, which is where all their growth is, which is ex-US, which is international, which fits in with all of our trades, you are going to continue to buy these high-end brands because you're going to drink less, but you're going to want more, and you're going to want it to be a luxury symbol versus a 24-pack of Natty Light. So Okay, Don Julio. So you can read through these things that I highlighted, the pluses, the minuses. Key is compounded sales growth 5 to 6%. They got smoked in stuffing the channel. The last CEO was a scumbag, basically. I'll take that back. But what he did with the financials was scumbaggery. They loaded the channels in Latin America and got smoked, and they're working through that destock cycle. Moving into a restock cycle. There was a lot of destock, restock around the world because of COVID. You had a monster level of front loading, both in the wholesale channels and then people buying it up. They're now drinking through their personal bars and starting to restock, and that's going to benefit Diageo. So they talk about why they have a moat, why they buy the small and upcoming brands, why they're going to continue to grow share. And this has been since the dawn of time. People will want to escape. People will drink alcohol, and Diageo is the best positioned player. I would not be a buyer of a massive beer player with the proliferation of GLP-1s. That's all carbs. It's all what people aren't necessarily going to crave, assuming that GLP-1s become as predominant as people anticipate. But even so, in the markets where Diageo serves, GLP-1s are going to be less and less of a factor, and it's already priced for Armageddon. So we like all of this. We've gone into a lot of the thing. They generated $2.6 billion of free cash flow during a cyclical trough, which we love because that means runway for the turnaround, new CEO, another key catalyst in turnaround situations, and a lot of good information here that we can cover. You see the whiskey growth in India is off the charts. Don Julio doing well. So continued opportunity, continued moat, continued compounder of capital. Guinness is going crazy. They got this new nitro tap that they're going to roll out around the country. They can't even make enough of their zero alcoholic 0.0 Guinness, which is growing really popular for all the GLP-1 people and people who don't want to drink. So all that's positive. Again, here is the CNN Fear and Greed Index at 29. This is not stuff you see at tops. It's stuff you see at closer to the bottoms. And then as a reminder, we're going to close out the Q1 opening at the end of this week. So if you're interested, go to hedgefundtips.com and click on money management, see if you qualify. As long as you get your entry in before Friday, you will be able to come in and get approved. The application usually takes about 24 to 48 hours. And then while you're at Hedge Fund Tips, click on terms. This is all opinion, not advice, not a solicitation. Do your own homework, talk to your financial advisor, consult the CLSA for your horoscope and what Hang Seng is going to do over the next 12 months in the year of the snake. Transport earnings estimates revisions. Transport's top 30 weights revised down by 27 basis points. Retail earnings, top 30 weights revised down 132 basis points. So that last 60 days, I think we'll see some positive things out of that in the earnings season and maybe adjust those pessimistic. Here's the inflation numbers we talked about coming in much better than expected. Earnings, again, just want to reemphasize which areas are going to grow earnings the most that are not yet pricing it in 2025. The answer to the question is healthcare, materials, industrials. Infotech is going to have healthy growth, but it's decelerated massively from last year, which should imply multiple contractions. So with that said, for those of you who like the Ask Me Anything questions section, we're going to get started now. For those of you who just tune in for the first part, thank you for tuning in this week. We'll be back next week, same time, same place. And here we go with question number 1. Jagar asks, do you have a condensed version of the podcast? I usually don't have 2 hours. Okay, this is the same guy. The answer is no. Wilhelm Kuhberger, could you please take a look at Anheuser-Busch InBev, similar to Diageo, but they have contracts with Coca-Cola for production? I just answered that question. Answer is no. I don't want a beer company. I want a premiumized, branded, special occasion, high margin, incredible business. Aaron L., given your relatively bullish outlook for healthcare, is Teladoc a stock that you'd be interested in. And I think we've covered this one in recent weeks. It's not for me. I think that you might get one puff out of this because of, but it's just every single private healthcare business is creating their own version of this. So why would they use Teladoc? Cash flow leveled off, revenues. Let's see here. TDOC. I have no way to determine if there's a moat. I think any healthcare provider could just say, we'll do your consultation over the phone. Why do they need Teladoc? So let me just see. It's probably cheap enough that you're going to get a bounce, but let me just take a look here. Okay, so revenues growth is decelerating. Revenue is still accelerating. They're still losing money. How can you continue to lose money? Shares, they keep growing the share count. All red flags for me. Negative return on capital. And this is dog shit. Excuse my language, but not for me. So play it for a technical bounce if you are inclined to do that stuff. But it's not a business that I want to be in. On to the next. Chris C. Celanese, we've looked at. Many times in the last few weeks. It continues to be on our radar, and I'm not saying any more than that. Chris Marlowe. All right. Big fan, blah, blah, blah. What are your chances that Crown Castle cuts its dividend? I think pretty low, and that's not why we're in it anyway. Next. Goran Stolcius. Wolf Semiconductor. Very low quality business, not interested. Ajit. Okay. Tom, if robot labor were to fill the demographic shortfall in China, would you reconsider your idea of ditching China growth, i.e. BABA, for Indian stocks in 5 years? The answer is no, because robots don't buy washing machines, houses, make babies, buy second cars when they're 35 years old, buy household wear, buy beds, buy this and that. Japan has had robots for 20 years. It hasn't helped them a cent. You got to make babies if you want to reaccelerate the growth in China. And so for that reason, we're going to ride this last parabolic move and say sayonara. Don L. Am I fair to say you really don't look at PE ratio? CCI. Well, CCI, you would never look at a PE ratio because it's a REIT and it's fund from operations. GXO looks expensive based on this metric. They all turnarounds look expensive based on that metric. That's why you don't want to do it, because you're buying it in the trough. What you're trying to figure out is what is the normalized growth rate over time, and when earnings recover, and then the PE starts to look extremely cheap when you look 2-3 years out, if it's a durable business with a moat and not some guessing the future for a new technology, which is indefensible and basically gambling. Jay Apt, keen to get your thoughts on bull and bear case for Dollar General. Dollar General, I think, is going to be fine here. This is part of the beat down on tariffs trade, which is a lot of the stuff which, when tariffs come in less bad than expected, it will rebound. Matt Mitchell, blah, blah, blah. Hershey, we like it. We're just not doing anything yet. We think it's going to come down. We've covered that 4 or 5 times in the last month. Next is Monique. How much further does Nike have to drop before it's worth a deep dive? I told you a million times, Nike's okay. We just prefer VF Corp, and we're not going to just load it up to do it. I mean, what we look for is expected upside, and Nike's not an easy triple. It's not even an easy double. Will it recover 40-50% over the next few years? Yeah, but that's below our expected IRR, so it doesn't meet the test. But if you buy Nike at $70 or $60 or $50, are you going to do well over the next 3 to 5 years? Absolutely. So nothing to worry about there. Adrian Smith was wondering what kind of resources you'd recommend for a beginner. Just read the Intelligent Investor by Ben Graham. If the light goes off, continue to pursue it. If it doesn't, just become an entrepreneur and make your fortune that way. Okay. Bought Baba before I ever heard of your podcast, but listening decided to stay the course. Averaged my position down to 81.73. I think 99% of the people on this podcast probably have a basis in the low 80s in Baba. And with some of your other picks, I've gotten my account up to 400,000 from 200,000 in a little less than 2 years. So thank you for everything you do. You're welcome. Where's my Christmas card? All right. Well, thank you for the kind words. I'm super happy. I hear a lot of those stories. And most of the stories are people who call me to become clients that have listened to the ideas, made money with them. And then they're like, what am I doing? I'm running another business here. I don't want to watch the markets. And then they just call me and they say, I'm putting 1, I'm putting 5, I'm putting 10, whatever it happens to be. And we're grateful for that. Hey, Tom, what do you think of VMEO and FVRR? It's from Lucas. FVRR, I don't know. There's just a lot of ways. Like, I've used Fiverr for different things. There's just ways to circumvent it. So I don't really love it. Revenues are rolling over a little bit. It's probably okay for a trade. I don't think it's a good enough business. VMEO. Take a look at that. And we've looked at Fiverr before and said no, so I'm not going to do it again. Vimeo is the video business. Wow, it's a tiny business. I don't understand this business well enough. It might be worth some study, but for me, it doesn't look like a good enough business to spend the time, so I'm not going to do it. That's a new client. Michael, I got that. Ryan, thoughts on Bear? We've covered it a million times. I'm a pass on that one. Griffin Brown, thoughts on INDA? Overvalued, not interested. Drew Robertson, EOSE. If this is the company I think it is, it's a hard pass. Yeah, I know the people involved, and I'm not for me. Next, Milan Kirshner. Listen to your podcast, shared with family members. By the way, thank you for sharing with family members. I appreciate you guys, number one, letting me know you're doing that. And number two, if you have been getting tremendous value from this and you're not able to be a client or otherwise, the best compliment you could pay is to suggest it to one friend or family member that loves the markets that could benefit from that. And that's how we grow. And the more we grow, the longer I'll keep doing this for non-clients for free. So very good. It's in your interest. It's in the community's interest. And I appreciate you doing it. Okay. I've been listening to your podcast for 2 years. I've shared it with my family members. Information you provide us on a weekly basis is truly priceless. So thank you. You're an embodiment of Lynch, Buffett, Munger, Tepper with a turnaround Tom twist to it. Thank you. I was wondering your thoughts on Dollar General. Yeah, again, this is down because of tariffs. I think it's good long term. Where does it exactly bottom right now? I don't know, but we have exposure to this theme with advanced auto parts, so we're not going to double down on the same theme, and we like the asymmetry of advanced auto parts and the leadership better. Now, this is someone asking me to run ads, which we don't do. And with that said, we are done for this week. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.